Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, or should I say, my friends. Come sit with me. Welcome to another vital episode of Equity Mates, where we're not just talking family business, we're talking the kind of business that sets you up for life. Whether you're a young consigliere just stepping into the world of finance, or a seasoned capo with a portfolio as hefty as a Sicilian feast, we're here to offer you an investment you can't refuse. And with that said, I'm here with my equity buddy Ren, as always. Who am I?
Bryce, you are the Godfather.
Yes.
Yes.
Well played.
Don't ask me characters' names.
I think the character is Marlon Brando.
Oh no, that's the actor's name.
That's my pop culture showing through.
There you go. Nice. Well, for people who are new to Equity Mates, welcome to the most confusing introduction in the finance game. Every episode, Bryce asks ChatGPT to alter his normal introduction, and I have to guess who it is. I always wonder about people who are new to the show and what they think as we get started. Yeah. But stick with us, because there's a pretty great interview coming up. We are speaking to an expert investor from Fidelity, Amit Goel, and he is speaking about two companies that we weren't familiar with.
No. Today's theme is the global supply chain shift. Amit is the portfolio manager for the Fidelity India Fund and the Fidelity Global Emerging Markets Fund. And the two companies that we speak about today really sort of fit right in both emerging and India.
Yeah. Well, I mean, he's right on the front lines of this supply chain shift as, from the 90s onwards, there was a massive offshoring movement to China, and that has sort of been the globalization story of the last 30 years. But the last sort of 5 years, really since the Trump presidency, there's been a real capital flight from China. A lot of manufacturing's gone to Vietnam. A lot of has gone to Mexico as well. And as we speak about in this interview, a lot has also gone to India. And there's a real shift going on. There's terms like nearshoring and all of that stuff are sort of coming into play. So it was like the Trump presidency, and then it was accelerated by COVID. And now global supply chains are really starting to enter a new paradigm. And whenever there's these massive structural shifts, there's big investing opportunities. And that's what we speak about today. And Amit is a great person to teach us about this, because he's had nearly 20 years experience investing in emerging markets. He's seen a lot of these markets develop and change over time. And
the good news is, if you are interested in investing in the Fidelity Emerging Markets Fund, it is available as an ETF under the ticker FEMX. And I think whenever we do these interviews, Ren, it becomes clear the value of active management, particularly in emerging markets and the smaller cap space. We've had a lot of discussion around India. So if you like what you're hearing, you can get access to the Emerging Markets Fund. The fund is Money Magazine's best international emerging markets fund for 3 years running now. So plenty of experience. And we really enjoyed this episode.
Yeah. Now, an important reminder that while we are licensed, we're not aware of your personal financial circumstances. Neither is Amit. So this content is for education purposes only. Do your own research. Get professional advice if you feel like you need it. But we hope this episode helps on your investing journey. And finally, this episode is sponsored by Fidelity. We want to say thank you to Fidelity for helping us make this podcast and make all of our content free for the Equity Mates community. But Bryce, with that said, let's crack in.
Let's do it. Amit, it is a pleasure to welcome you back to Equity Mates.
Yeah, great to be back at Equity Mates.
So to contextualize the conversation today, we've got two stocks that we're going to discuss that center around the idea of the shift in the global supply chain. So to kick us off, can you explain what this shift is and help us understand how it places the two stocks that we're going to talk about today?
So when you think about shift in global supply chain, it is all coming from the fact that we are all living in a more polarized global world. I mean, the world went through a very big globalization cycle from start of 2000s till 2020 when COVID hit. Then we saw massive supply chain disruptions from COVID. A large part of global supply chains shifted from west to east over the last 20 years, primarily to China. Everything that you and I and everyone use on a daily basis, whether it's our iPhones, or whether it's our consumer electronics, gaming consoles, pharmaceuticals that we have, will find all their supply chains going back to China in some shape or form. So the world was very globalized. The inventory was just in time. Everything was working fine. And then we started to have a bit of this geopolitical situation between US and China in 17, 18. And then we had COVID, massive disruption in supply chains. And I think all that is leading to a more polarized world where everyone is looking to diversify these supply chains and dependence on just one country or one region or one area for critical components, critical part of your economy. I mean, we have seen that in last 1 or 2 years, where a lot of global companies are now talking about creating parallel supply chains out of China into Southeast Asia, into countries like India, Mexico. It's a very slow process because what we have seen is that the supply chain shift took 20 years to move from west to east. And now, when you are trying to replicate or diversify it out of very scalable supply chains, I think it's a very slow process. But it's a process which I think has started. It will take years and years to diversify out of the supply chains if at all we can. But I think that process has started.
Well, I love this like big shift and the opportunities that are springing up amongst it. And I guess to give a sense of just how broad the opportunities are, the two companies that we're talking about today, one is in India and then the other is in Latin America. So it's truly a global supply chain shift that we're talking about today. Let's start with the Indian company. KPR Mill is its name. It's in the textiles space, but rather than me doing my best to explain it, I'll let you. So introduce us to the company, Amit. What does it do and what do we need to know about it?
So KPR Mill is a fully vertically integrated textile company. They start from cotton. So this is a company which makes cotton garments. We call them knitted garments. They start from cotton. So it's a fully integrated company which starts from cotton, purchasing cotton from the farmers in India. And then they make garments as their final product, which they supply to global customers like H&M, Marks and Spencers, Decathlon, and some others global customers.
And so, I mean, what are the big macro drivers or factors that are driving growth for KPI Mill? And I guess tying that back to the thematic, which is the global shift in supply chains.
So if you think about the global apparel industry, I mean, it's a very large industry, and a large part of that shift has already happened from west to east. So all garments that you and I use on a daily basis, whether we are talking about very simple t-shirts, or whether we are talking about jackets and our formal clothing, whether we are talking about our sportswear and running t-shirt and yoga pants, they're all now getting manufactured in mostly in Asia. A large part of it is getting manufactured in China, where the whole supply chain shifted in early 2000s. And then in last 10 years, large amount of that supply chain has already started shifting to places like Vietnam, Cambodia, and Bangladesh. This was also driven by the fact that the cost of labor was increasing in China, and this is a very labor intensive business where garmenting is still done using a lot of labor with sewing machines, but still a very labor intensive business. So as cost of labor was rising in China, there was a big shift happening towards Southeast Asia as well as countries like Cambodia and Indonesia. But what happened is that with this big geopolitics that we talked about, and cost of labor still rising in now Southeast Asia, I think India has become one of the destination where some of these global buyers or global brands are looking for diversifying their supply chain. The issue with India was always that there were labor issues, and as I said, this is a very labor intensive sector. Companies would find it difficult to create scalable large labor force facilities. But that is something which we saw a big change in last 5 years, where now the ability to manage large labor force under one roof has improved. And now companies are seeing more and more integrated large plants coming to India.
So, Amit, that's the sort of the global backdrop and the macro context. If we then zoom in on KPR Mill as a company, how is it capitalizing on these shifts? And probably most importantly, from an investment perspective, why KPR over some of the other big Indian and Southeast Asian textile players?
When it comes to KPR Mills, it was very interesting that I went to India in May and we spent a full day with this company. This is not a new company. This is a very old company. It was started by first generation in 1980. So it's a almost 40-year-old company. They started doing the textile business. They were largely doing the yarn and the fabric business. And about 10-15 years back, they started moving into garmenting and making cotton garments, t-shirts, etc., for large clients. If I break the business today, the business is broken down into garments, which are their final products, but they're still supplying the intermediate textile products like yarn and fabric to third parties. So it's a business which has been vertically integrating. So I think if you think about garmenting, being a vertically integrated players is always a very strong place to be, because that gives you a lot of scale and flexibility in terms of raw material sourcing and managing your quality as well. When it comes to why KPR Mills versus other Indian companies or other kind of Southeast Asian companies, first, as I talk about that, there is a clear shift in market share. I mean, Indian companies are still very small on a global scale. And because of all the labor issues and scalability issues that I talk about, so we haven't seen a big shift of supply chain of garmenting out of China or Southeast Asia into India as of now. So now what we are saying is that that shift has just started. So you are talking about a global industry, which is a very mature industry, but now you're talking about Indian companies which are sitting at a very low market share. I mean, we are talking about a low single digit market share for Indian companies in this whole global market, and that market share will keep on increasing from here. So in a mature industry, you're getting to a company which can keep on increasing market share. So that's one very important point. But where we focus a lot more on is how good is the company to capture that shift in industry structure or market share. And I think when I spend a lot of time with this company, I found this company being very interesting. So as I said, this company is a fully vertically integrated player. They start from cotton and they finish with the garment. But when I saw their operations, I mean, I saw their cotton warehouse where they store cotton. I saw their yarn factory where they spin cotton into yarn. And then I saw their fabric factory where they make fabric out of the yarn. And then I went to their garmenting factories where you will see massive lines where a large amount of women workforce would be sewing these clothes. I found those operations very sustainable. They have one of the most kind of hygienic factories that I saw when you compare that with factories in Bangladesh, etc. They have a very sustainable workforce. I mean, they have today 25,000 women working in their factories. So it's primarily women workforce. And all those women are anywhere between 20 to 25 years. They came from very different parts of India. They all live on the campus, very good living conditions. 7,000 out of 25,000 women workforce get educated on the campus. I mean, they're doing various educational courses from high school to till postgraduate. So it's a very sustainable business model that they have created, and I think that aligns very well with large customers. I mean, we are talking about large customers like Uniqlo, H&M, Marks and Spencer, Walmart, and then going into more specialized players. I think that's the goal in 5-10 years time, when they should start working with people like Nike, Adidas, Puma, Lululemon, etc. I mean, that's the journey that they have to do over next 10 years. But I think when I saw their operations on the ground, I think that looks very sustainable for me to achieve that high global market share with this company can do. I mean, today we are talking about them producing 120 million garments every year for their customers. Half of that goes to Europe, 25% of that goes to US. Um, a good amount of that goes to Australia as well. And now India has a free trade agreement with Australia, so that business will increase. But I think they're still at the low end of manufacturing. I mean, they are producing cotton clothes, garments, which are sold at about $15 to $20 in stores, and they sell it at $2. If I see some of the Vietnamese companies and some of the Chinese companies, they are selling 400-500 million pieces, but at an ASP of $10. So I think I see this company in 8-10 years time going to from 120 million pieces to 400-500 million pieces, but also from a $2 ASP to $4-5 ASP. So that's a massive increase in market share, but it all comes from the fact that how sustainable these operations are. And I find a lot of kind of sustainability, their ability to scale these operations by all the business practices that I saw on the ground.
Certainly sounds like there's some serious upside if it does play out how you just sort of pictured it, Amit. I guess the question is, if they're so vertically integrated and they're one of the world's largest producers of cotton and obviously creating cotton garments, but a lot of their, I guess, end retail customers, Zara, H&M that you spoke about, Lululemon, for example, are using more and more synthetic fibers in the production of their garments. So how are they going to, or how are they positioning themselves to still be able to, I guess, manufacture as materials change over the next 10 or 20 years?
No, that's a great question. And KPR Mill is largely pure cotton garment producer today. So they don't make synthetic garments. I mean, and as Alec, you rightly mentioned, we're talking about these yoga pants from Lululemon, the running t-shirts from Nike, Adidas, Puma, etc., Uniqlo. So they don't work at that end of the market, and that's also a growing end of the market. That's also where specialized textiles are coming, which are more functional in nature. So that's a journey which this company has to do. I mean, if you think about a start, I think that's how everyone starts. I mean, when I talk to this company or any other player, what I think is that this whole moving from pure cotton to a specialized synthetic fabric is, I think it's just a matter of learning. I mean, what happens in this specialized fabric is that you are blending different materials to create more functionality and strength of the fabric. And this is a matter of R&D. I mean, getting to these fabrics. This is a matter of working closely with your customers because some of this technology lies with customers as well. I mean, I have seen companies in Taiwan which work with some of these synthetic players that you talk about. I've known companies in China, and I think they can do it over a 5-10 year period of time. So again, that's my thought process, that first you are able to create a sustainable, scalable structure in your company, which I think gives you ability to interact more with some of the large customers. Then you work closely with them, create these new products, and scale them for future growth. So I think that's a virtuous cycle, and I believe the company has started to be in that virtuous cycle.
All right, Amit. Well, that is a fascinating company. I hadn't heard of KPR Mill, but certainly another Indian company that's been spoken about on the show recently that is really interesting and certainly one to keep an eye on. We're going to take a quick break here, and then on the other side, we're going to fly over to the other side of the world. We're going to fly to Mexico and land at an airport operated by the second company that you're going to talk to us about today. Welcome back to Equity Mates. Today we're speaking to Amit Goel, who is the portfolio manager for Fidelity's India Fund and for Fidelity's Global Emerging Markets Fund. No better person to speak to us about the massive shifts going on in global supply chains. Before we speak about the second company that really exemplifies the shifting global supply chains, I want to give everyone a quick reminder that if you want to go deeper on today's episode, and if you want to have your questions answered by some of the best advisors in Australia, sign up to the Equity Mates mailing list, the email that accompanies this episode. All the information's in the show notes. Amit, before the break, we spoke about an Indian company. Now we're going to the other side of the world and speaking about a Mexican company based in Guadalajara, Mexico. And I am going to butcher this pronunciation, but give me a crack. It's called Grupo Aeroportuario del Pacifico. So my first question is going to be, can you teach me how to pronounce the company's name? And then the second question is, what does it do? What do we need to know about it?
I struggle as much as you. So we call it very simply Grupo Aeroporto.
Great.
And the ticker on Bloomberg is GAP-B, which is again a very easy pronunciation. so makes it easy for us. It's I think it's a very interesting space that we are looking at now. I mean, we started this podcast talking about this global shift in supply chain. And I think what I didn't mention at the start is that this is a very gradual and slow shift. If I give you a few numbers, which makes it very easy for our listeners to, I think, make sense out of it, is that what is essentially happening in the world is that US had a big export deficit with China. So US almost had $500 billion of trade deficit with China, which was 50%, half of US trade deficit. Then what happened from 2017, I mean, this was a 2017 number, over last 5-6 years, US, with all the trade and geopolitical situation that we talk about, is very much focused on reducing that trade deficit with China. And US has been able to do it from $500 million to $300 million. So it has gone from 50% of US trade deficit to 30% of US trade deficit. But China has not lost global market share. I mean, we're talking about shift of supply chain, but China hasn't lost market share in a global trade. So what has happened is US is importing less from China, but US is importing more from countries like Mexico, Vietnam, India. So in turn, these countries are importing more from China and exporting to US. And what they are doing is they are doing some last step in the whole process. So if you think about textile, I mean, some of the textile are still getting manufactured, synthetic textile manufactured in China, getting imported and going into garments. You are thinking about mobile phones. More and more mobile phones are getting now manufactured in India and Vietnam. Foxconn, which is the largest supplier of Apple, are creating facilities there. But all the components are still coming from China. When it comes to Mexico, it is very interesting because that's where the nearshoring becomes very important. I mean, we have been hearing about nearshoring for 10, 15 years, where US is trying to create more and more capacities in Mexico. And it has never happened in 10, 15 years because China was such a large scalable players in each and everything that the cost would not be optimized even if you create capacity in Mexico. Now with this focus on shifting on supply chain, I think we have started to see new projects rising in Mexico. I mean, the number of new projects which were announced in last 12 months was more than any year in last 10 to 15 years in Mexico. We are seeing these projects in areas like auto and auto components, consumer electronics. These are two large areas, but in machineries, etc., in industrials, that's where we have started to see projects announcements coming in Mexico. Mexico is still a small economy, and we found it a little bit difficult to find direct beneficiaries here. I mean, we are looking at steel companies, cement companies, because there has not been any capacity addition in those areas, but they still remain very global cyclical companies. So one stock that we have entered into our portfolio in our global emerging market portfolio this year is this airport company called Grupo Aeroporto. Mexico has three large airport companies, and these three companies are having most of Mexican airports in their portfolio. So Grupo Aeroporto, which is called GAP-B in its short form, has about 14 airports in their portfolio, and 12 of these airports are in Mexico. Most of these airports are in west and north part of Mexico, and they have two airports in Jamaica. Out of their kind of Mexican airports, roughly one third of the travel is business travel. I mean, mostly in kind of north part of Mexico, and two-thirds of their travel is leisure travel. 25% of their travel is international, while 75% of their travel is domestic. What we have seen in last 10 years in Mexico is that the number of passengers have increased by about 10% CAGR. The pricing per passenger and the airport gets the landing fees and per passenger fees has gone up by 5%. So their aeronautical revenues, which they get from passengers and planes, has grown at a CAGR of 15% every year. On top of it, their non-aeronautical revenues, which they get from shops and retail at airports, has grown at even a faster rate of 17-18%. So this is a company, because of the air travel, both business and leisure, increasing in Mexico at a good double-digit rate, has compounded for last 10 years at about 15%. We believe that with economic activity improving in Mexico and Mexico getting higher global trade share, this will be an indirect beneficiary. I mean, with higher economic activity, you will have higher business travel, but that should lead to a higher airline share of travel in Mexico itself as well. So we find this company very interesting, where we think there's a structural growth of airline travel driven by higher economic activity and higher business activity. It is available at very reasonable prices to us at 15 times price to earning next year. There's a concern on airports because it's a regulated business. Every 5 year government decide the tariff, but we believe that when the tariff gets decided next year, this company should still be able to make about 20-25% return on capital. So you have a business which is 20-25% return on capital, which still can compound at good double digit, and it's trading at 15 times price to earnings next year, pays us 4-5% dividend yield. So we found this a very good way to play that economic activity change which we are seeing in favor of Mexico.
Love it. Another fascinating company, and this is why I love speaking with you, Amit, because you bring stocks that we've never heard of, but really playing into a large macro theme. I guess just to close out, how big do you see Grupo Aeroporto getting over the next sort of 10, 20 years?
So if you think about market cap of Grupo Aeroporto, we are talking about today roughly $8 billion market cap. I think this company should give us a very good, I would say, mid-teen compounding, which is a combination of growth and the dividends that we get out of the company. I mean, if you think of a total shareholder return, we are talking about this company being $15 billion market cap company in 5 years time, and again continue to compound from there on. So it will be one of the larger airport company in that aspect. So I mean, as shareholders, we are really looking at companies which can give us a sustainable compounding of double digit for our shareholders, very high return on capital, less cyclical business, and Grupo Aeroporto is one of those businesses which we believe will have those characteristics.
Awesome. Well, we are at the end of our time. We do thank you very much. I should just say that we've spoken about India and emerging markets here on the show in the last sort of month or so, and it becomes pretty evident this is where active management really does play a good role for us. And you've just demonstrated two companies that are really benefiting from large macro trends in companies that we can't directly access ourselves. So thank you so much for your time. We do really appreciate it, and look forward to catching up again at some point to hearing more interesting stocks. Thanks, Amit.
Thanks a lot for having me here, and it was a great discussion, and always happy to discuss some of these interesting ideas which adds active alpha to our clients.
Yeah, absolutely. Well, we do appreciate it, and I'm sure the Equity Mates community do as well. So thank you very much.
Thanks, Amit.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.